McGee Wolf with the Wolf Group. I thought I'd whip out a quick video, first of all, to say I hope everybody's doing okay. This is the first Monday after what a crazy week we had last week. I know people are scared about the coronavirus, and it is a serious issue. And I just hope everybody stays safe out there and takes all the precautions necessary to keep themselves and their families safe. But a whole lot has been going on in the mortgage industry, in the financial world, of course. The government has been running from pillar to post to try to get things right for us. I'm not going to sit here and talk about everything that's been happening, but they've been making a lot of moves, as I'm sure you know. And the one that has affected the mortgage interest rates the most is what they did on Sunday. They did several things on Sunday, but the government decided to begin quantitative easing again. I know that's a fancy term, and I want to try to explain what it means. And what it does is the government decides to purchase mortgage-backed securities again, which frees up capacity for these lenders and these investors out there that are lending money on all these mortgages. Now, all of you have heard that the federal government has cut the interest rates to 0%. Well, today I received a handful of phone calls from clients thinking they might be able to get a 0% interest rate on their mortgage, and that, of course, is not going to happen. They're a little confused on what is 0%, and that is the Fed funds rate, which is the rate of interest that big banks charge each other for very short periods of time, sometimes only for overnight. So the consumer doesn't have access to that interest rate, but it does have an impact overall on the economy, and that's what the government is trying to address. I think they're trying to address the overall economy way sooner than mortgage interest rates. But today, our interest rate environment improved considerably over what happened last week, which defied all the rules, so to speak. There are not a whole lot of rules in investing, but generally speaking, when the stock market goes down, people sell their positions in the stock market, and a lot of times they put their money in the safe haven of the Treasury and the bond market. And when that happens, interest rates improve. Well, we had I think 4 straight days where the stock market deteriorated. Maybe it was only 3, but we had 3 or 4 straight days where interest rates got worse and worse and worse. And in fact, on Friday, when I sat down at my desk, the market opened and interest rates got worse again. I literally screamed out loud. I was pretty upset. But of course, nobody can control it. But let me explain what I think has happened, or in terms that you can relate to. The biggest issue, in my opinion, when the market should have reacted favorably toward interest rates, but they didn't, was all of these big banks and these investors had a capacity problem. And what do I mean by capacity? Well, let's think about it. Last year, in 2019, the whole year in the United States, we closed about $2 trillion in mortgage loans. Well, in the last 30 days, in the U.S., with interest rates going down, there have been $2 trillion of mortgage applications made in 1 month. So try to imagine what that means to a normal business. How can they handle that kind of growth? And when you think about it long term, there are about $11 trillion worth of mortgages in the U.S. right now that have a loan to value of 75%, which is a pretty comfortable position to be in, and they are great candidates to refinance. So all of these investors and big banks can see the freight train coming. That $11 trillion is coming down the railroad track straight at them, and they don't know what to do. They can't handle that kind of volume. I mean, imagine your favorite small romantic restaurant that you love to go to, and they may do 20,000 meals per year. Very high end, great restaurant, wonderful service, but all of a sudden their restaurant becomes so popular that they need to be serving 20,000 meals a month to try to keep up with the volume. How could they possibly do that? There is no way. What would part of their solution be? Well, they have to raise prices to try to slow down the volume. So that's one of the things that happened last week when all the market indicated that interest rates should be going back down, but they actually were going up. These big banks and investors were raising their rates to try to stem the tide of all the volume coming in because they didn't have the warehouse line capacity for those loans. Their staff didn't have the capacity for their staff to handle it. Imagine the restaurant. How many staff members are you going to have in order to serve 20,000 meals in a month when you're accustomed to doing it 20,000 meals in a year? It's just not possible to adjust to that kind of volume in an instant, in a week. I mean, it takes years to develop that kind of infrastructure to deal with that. So don't blame your lender if things didn't work out for you 2-3 weeks ago when the interest rates were low and they couldn't quite get your loan in process and your interest rate locked. Now, if they told you that your interest rate was locked, but it wasn't, well, that's a whole nother story. But my message to you is that interest rates are at a historic low level. It's not likely that we'll see in our lifetime an interest rate in the above 6%. I'm speculating, of course, because they are going to vacillate. But we're probably not going to see it again for somebody who has solid credit. Their affairs are in order. We're probably not going to see interest rates above 6% again, which is good news. But why do I believe that? Well, because debt on a national level and our government, when they have so much debt, it suppresses interest rates. It keeps them low. And as long as we have politicians that love to spend our money, we're going to continue to go into debt, probably further and further. I don't know what the answer to that is. I mean, that at some point, it's going to come home to roost. But for right now, in the foreseeable future, we have a government, whether on both sides of the aisle, Republicans and Democrats love to spend our money. So we're probably going to have low interest rates for a while. So what should you do? Well, if it were me, I would get my credit straight. I would get very organized, get your application and documents in, whether you're looking to refinance or purchase. Be patient, but most of all, be smart. Don't overreact to things. And it's very easy to do. We all do it. But this is a long-term play. And I just encourage everybody to just take a deep breath and relax. We're going to get past this. The coronavirus is not here to stay. We've learned something, but it certainly has affected our markets, and fear rarely creates anything good. So don't be afraid, be prudent, be smart, and as far as your mortgage is concerned, just get organized and do the right thing and be patient and make great choices. I hope this was helpful. Have a great day.